Hello everyone. In previous lectures, we were covering ratio analysis. In this lecture, we will cover the last type of ratio analysis, that is profitability ratios. The profitability or financial performance is mainly summarized in the statement of profit and loss. The profitability ratios are calculated to analyze the earning capacity of the business. There is a close relationship between the profit and the efficiency with which the resources employed in the business are utilized. The various ratios which are commonly used to analyze the profitability of the business are gross profit ratio, operating profit ratio, net profit ratio, return on investment, earnings per share, dividend payout ratio, dividend yield ratio, and price earning ratio. Let's start from the first one, that is gross profit ratio. Gross profit ratio established the relationship between gross profit and net sales. Higher gross profit ratio is an indication that the firm has higher profitability. Now, gross profit ratio is equal to gross profit upon net sales into 100. Now, gross profit is equal to sales minus cost of goods sold, and net sales is equal to gross sales minus sales return. Moving on to the second one, that is operating ratio. Operating ratio is calculated to measure the relationship between total operating expenses and sales. The total operating expenses is the sum total of cost of goods sold, office and administrative expenses, and selling and distribution expenses. In other words, this ratio indicates a firm's ability to cover total operating expenses. In order to compute this ratio, the following formula is used. Operating ratio is equal to operating cost upon net sales into 100. Now, what is operating cost? Operating cost is equal to cost of goods sold plus administrative expenses plus selling and distribution expenses. And we have already discussed the formula for net sales, which is equal to sales minus sales return. Third one is operating profit ratio. It indicates the operational efficiency of the firm and is a measure of the firm's ability to cover the total operating expenses. Operating profit ratio is equal to operating profit divided by net sales into 100. Now, operating profit is equal to net sales minus operating cost. Now, as we have already discussed, operating cost is equal to cost of goods sold plus office and administration expenses plus selling and distribution expenses. Next one is net profit ratio. Net profit ratio is also termed as sales margin ratio or profit margin ratio, or we can say net profit to sales ratio. This ratio reveals the firm's overall efficiency in operating the business. Net profit ratio is used to measure the relationship between net profit and sales. Net profit ratio is equal to net profit after tax upon net sales into 100. Moving on to the sixth type, that is return on investment. This is also called ROI. This ratio measures a return on the owner's or shareholder's investment. It establishes the relationship between net profit after interest and taxes and the owner's investment. Usually, this is calculated in percentage. ROI is equal to net profit after interest and tax divided by shareholders' fund into 100. Now, shareholders' investment or funds is equal to equity share capital plus preference share capital plus reserves and surplus minus accumulated losses. And net profit is equal to net profit minus interest and taxes. Next one is earning per share. It is also known as EPS. It measures the earning capacity of the concern from the owner's point of view, and it is helpful in determining the price of the equity share in marketplace. Earning per share ratio is equal to net profit after tax and preference dividend divided by number of equity shares. Next one is dividend payout ratio. This ratio highlights the relationship between payment of dividend on equity share capital and the profits available after meeting tax and preference dividend. It indicates the dividend policy adopted by the top management about utilization of divisible profit to pay dividend or to retain or both. Dividend payout ratio is equal to equity dividend divided by net profit after tax and preference dividend multiplied by 100. Or another formula for dividend payout ratio is dividend per equity share divided by earning per share into 100. Moving on to the next one, that is dividend yield ratio. Dividend yield ratio indicates the relationship which is established between dividend per share and market value per share. This ratio is a major factor that determines the dividend income from the investor's point of view. Dividend yield ratio is equal to dividend per share divided by market value per share into 100. And the next one is price earning ratio. This ratio highlights the earning per share reflected by market share. It establishes the relationship between the market price for an equity share and the earning per equity share. This ratio helps to find out whether the equity shares of a company are undervalued or not. It is also useful in financial forecasting. In order to compute this ratio, the following formula is used. Price earning ratio is equal to market price per equity share divided by earning per share. Thank you.